Einen schönen guten Abend und auch
Good evening and welcome to the second edition of the trading event, Swiss Trading Day of IG. I am a client manager and market analyst with IG, and I'm very happy to be on the stage with Dr. Bauer. Dr. Bauer will explain his trading set and share us a couple of markets live. If we have enough time, he will react to your comments and questions. If you would like to ask questions, Dr. Bauer will answer very happily. But before starting his presentation, I would like to take a couple of moments in order to understand our mission with IG here in Zurich. I don't want to present our products or our platform. If you're interested, please go to the trading stations and take a look. My colleagues and myself will happily answer your questions. And otherwise, come to our offices at the Paradeplatz. We'd be happy to see you. But tonight, it's only about your information, your education. When you go home tonight, I hope that you take 2 or 3 hints from every presentation with you in order to become a better trader, because that is our mission here in Switzerland. We don't want to be a bank only and offer products and platforms. We want to be a trading partner and help you on your way in trading. In a lot of conversations about trading, if it's professional or private, the question always is, which strategy should I adopt? Often I'm asked which strategy I'd recommend in order to earn money very fast, but there is not the only strategy that you can use for many traders, because every one of us is different. We have different risk awarenesses, we have different amounts of time at our disposal, and we have to be conscious of that. But I can promise that for every type of trader there is the right personal strategy, but you have to develop it. And it's very impressive. Ron Williams showed it. The trading strategy is a key element for success, but not the only one. Psychology also plays a key role. And we will see how important that is. If you go to a big bank, you see certificates, structured products, bonuses. Why? Because they know how human psychology works, and they know how to influence a human being in order to make him or her feel safe. And that safety costs a lot of money. If we as traders understood ourselves, our mistakes, that would cost a lot less money, especially if we knew how to correct our own mistakes. Mr. William just explained it. You've just seen a slide about the losses and the importance of losses. A loss is 2.5 times more important than a benefit. At the same time, that means that in a losing position, we take higher risks. Many of you know the position where you lose and then you double what's at stake. It's not really a rational behavior. Why? Because you would like to be at least at zero. But very often that doesn't work. And especially for that reason, it's particularly important to understand that point. The problem is not only on the side of the losses, but also on the positive side. Maybe you remember how you felt when you won for the first time. I was really happy. The second time a little less, and so on. So you take higher risks, even if you're not conscious of it, in order to have that sensation of the first time you really won, in order to feel positive. And that's irrational. That human behavior has to be known and understood. And that is why we would like to take a closer look to that kind of behavioral mistakes in order to understand them and, as we hope, then correct them. But trading success also means a correct risk management. If I had to explain a risk strategy today with a 50-50 risk, we would probably be able to find a majority who would say that strategy is not really good. But if you have a reasonable risk management, if you limit your risks, if you have a fixed ratio of 2-to-1 maybe, then it's a profitable strategy which will help you gain money. And if you have a profitable strategy, you might not use your time in order to run after your losses, but you can use that time in order to improve your strategy even more. And then you might have 55-45. But money management is important, because if you only have a strategy but you're in the wrong position, your strategy won't help. So, to summarize, we have a strategy that is a key factor of trading, of course. And strategy does not only imply one single indicator, but you need to find the right formation of indicators that are completing each other. We have the Bollinger Bands tonight, an indicator that should be a part of your strategy because you see the volatility of the market in which you work. So, as a summary, you can say that your success depends on the strategy, but the strategy depends on indicators, risk and money management. And that is exactly where our work starts, and we as IG Bank would like to help you to find the right educational offers in order to learn how to react to these different situations. I might present our perspectives for this year. We have a cooperation concerning technical analysis. We had a course concerning technical analysis which will be continued this year. But this year we would also like to show you live trading. Mr. Bauer will start this. We will have Mr. Pfister, the president of the Swiss Association, and in May another expert from Germany. And there you have the opportunity to observe the professionals, to learn from their mistakes, because nobody is perfect. But we would like to give you the opportunity to learn from the professionals. Other topics will also be considered. So please take a look at our website. We publish our courses regularly, and last but not least, we have the IG Academy mentioned by Mr. Bajali before, so you can also take a look at the courses we suggest with the Academy. But here in Switzerland, we would like to be your trading partner. We would like to help you. Please come and visit us in our offices, and especially take a look at our educational office on our website. And now I would like to hand the floor to Dr. Bauer. Thank you very much. I thank you. I'll give a hand to Christos Maloussis. Who already introduced me. That is perfect. He already did my introduction. Because we will now take a look at practical trading. And during the time we spent together, I would like to give you a couple of ideas about how to approach markets with very simple tools. And simple tools mean chart techniques, visual charts, and indicators. And that goes together. But we will not use many chart indicators. I'll only have 3 of them. That expresses all you need to know in order to have the basics for trading. And it's already been mentioned, Ron said it, we need a concrete training approach, and we need to have an idea about where we'd like to go. You cannot work out a system or trading plan if you don't know where you are and how you can leave the market. And that is where technical analysis starts. And these are efficient approaches you can adopt at any time, for any period of time. You can combine it with indicators, and then we'll take a look at the markets and what's going on currently. We'll take a look at the euro, the dollar, and so on. And we'll just try to analyze the markets and what could be an efficient trading approach. First question, who of you is an active trader? Okay, and the others? You never traded live? Only very few. Who has knowledge of technical analysis? Hands up. Very honest question, just for me to know. Who doesn't really know about technical analysis? So you're all experts. Well, that's great. I'm very enthusiastic about that. So we'll start. What does that mean? Already heard about wave patterns? Do you think they're good? Who thinks they're not so good? Not so helpful? Just a personal opinion, but I'll still explain what it means. The basic wave pattern from 1 to 5, without deepening the theory, is the foundation of the wave theory. But I would like to explain something else. The basic wave pattern, you all know about that. Markets go up and down, and so on. No, that's not really new. What's new about it? You like this? You can see it? You can see the laser pointer now? So what I'd like to show you is this recurrent structure with visual patterns and indicators that confirm the initial pattern. So that's the following scenario. The market is going down. You're at the lowest level. It increases. We have the first wave. You just have the numbers for the waves, but that's not what I like to analyze. But after the first correction, it goes down. You might have observed it. There's an increase, and then you correct the increase. And the destiny of the next movement is decided here. The destiny decides that the market will go even below the first risk, then the trend goes further down, or at this point there might be another increase. And this increase, and you can really show it, is in general the wave number 3 and the longest movement. And then we have to think about what happens on the market. The market, that's us, you, me, the very small ones like me, the bigger ones are like consultants, and the big players are the banks. We all are the market. But what is going to happen if here you have a certain pressure on the market? I would like to sensibilize you for the market. So if you have this turnaround, and we'll take a look at turnaround patterns later on, it is a decisive moment. Why? If it turns around here and you have further pressure on the market, the highest point from before is your destiny, the resistance of your destiny. Why? Because if you don't go further up, but you go down from here, that means that you have encountered resistance, and that means that you have too much value on the market because so many people have already bought it. But nobody will buy if they know that it's not working. So it's very important to take a look at that marker. And if the market continues, then you will have further pressure to buy. And what you'll see then is the following. Once the movement is launched, then you have trends. You have the institutional players, and everybody comes into the market, even the big ones, the hedge funds, and the market is pushed furthermore. Sooner or later, it will be in the Bild Zeitung, a German newspaper. Then everybody is in the market, and then the market will decrease because it is corrected once again. But what is really interesting is the first scenario, because if you understand that, then you'll have the best opportunities. You'll never know for how long it will continue to increase, but you can at least understand the risk. And if the market decreases under the first point where you had a risk, then you should leave it. So you should need to know where you find your risk, and the risky point is here. Here you'll have a zone of benefit, and there will sooner or later be resistance. Do you understand the terminology? Resistance, the zone where the rate is going and when it falls, and then a support. That's the opposite. And now we will take a look at the classical charts. You might know them. I don't want to take a look at every single chart pattern. I would just like to show a couple of typical charts. You might know the rising triangle. You might have read that before 1,000 times. You have, but it really works well. But why does it work so well? Not because it's in the books, but because you can think about what's going on. So think about why the market is going in that direction. What is going on and what can you take from that chart? The pressure of buying and selling. If you want to be successful in trading, you have to follow the market because you are too small and the market is too big. So if the market is falling and you're wrong and you're slow, it will continue to fall. So you have to follow. But if you have a rising triangle, here you have the author, you might know him. And I can only recommend his website, the pattern site. It's very interesting. I don't know if you've heard about it. And he realized that a rising triangle will always have a breakout on the upside. So here you have a correction. Here's the resistance. And that means that the market is bullish. Investors buy. Here you can see it, and the triangle is really nice. It's a nice figure. They buy, but here somebody is selling. And you can see this when a big player sells something or something similar. But if he stops selling and the market is still bullish, it will go further up. And here, in general, you will have the first push. Then it will go down once again and will go even further up. And then you have the falling triangle on the other hand. Support. And then take a look at the highest points. If you see something like this, you shouldn't go long. Even if you might think that the market might have a breakout on the upside, but generally it will not have it. They sell on a low. Investors would like to quit. They're happy to be able to sell here, and here, and here. So don't go in if you see something like that, but wait for the breakout on the downside. Something else that might happen, and that's really smart. Let's take an example. We have a breakout on the downside. It's going back up. I'll explain the second opportunity later on. And then we're once again within the figure. it's increasing herein, then a trader like you really has the opportunity to compensate and to finish in this kind of zone. So what I'd like to say is if you expect a breakout, it happens on the upside or on the downside, and then you have a reversal of the breakout. That is not the sign for you to start. The sign for you to start comes when the initial level has changed, because then the setup is totally different. So it goes down, it goes up again, and then a question mark. We don't know what's going to happen now. But if now we have an increase after that breakout on the downside, in that case, you would really have an opportunity for a further increase, but only after the market has shown you that that was a wrong breakout on the downside, and not when you're herein. Then the statistics are against you. Something similar, you probably heard about that before, about flags. I don't need to explain the details now, but what I like to explain is the idea behind it. Why this figure of a flag? It's just an increase, a short correction, and then a further increase. There is another breakout on the upside of the market. You can show it in the statistics. It's not really difficult. People do it and analyze it and evaluate it. And now you can ask the question why a flag works. Why you have that breakout? There was already an increase, so there should be a correction. No, that's wrong. The behavior of a trader is totally different. If you have a very strong increase and then the market is corrected, that's great. Great for you. There is a correction. Of course, there might be a problem. Then the flag will not be finished. But just imagine the market has a correction and then there's once again a lot of pressure. What does it mean? That means nothing else than a short correction on a bullish market. Or maybe incentives. That might be a good strategy if you're a big player. You just use a couple of hundreds or thousands. The market will decrease and then it will increase again because everybody starts investing. So on the whole, the market is still positive, and the small correction after that important increase shows that there is still a lot of pressure.
That just shows that if the flag goes up, you can really have a very good win potential. While I'm saying this, it also means that we have no guarantee because, of course, we also always have a stop. When we're talking about trading, we're always talking about eventuality. We start to trade if the eventuality that the trade is going towards the right direction than in the opposing direction. And none of us here in this room, maybe you, but I don't, can predict which trade will go into the right direction. We can only just presume. We just work on presumptions. What could be, what direction could the market go to? So what's very important is always to set when the position seems to have a turning point. And here, so that would be our turning point in this case. So you enter the market here, the setups. When is it going to be shown that you are wrong? At that point, when you have a market development that you don't want, then of course, how can we foresee this is when it goes up and it goes down again and we have this low. It doesn't matter which market we're talking about. It's the same with the head and the shoulder principle. You probably all know this. It's this setup. Down, down, even lower down, and then another up and down, low. And here again, we have the same idea. All of these are very simple market development, which are very efficient to show you where is the chance risk behavior that you can take the opportunity where you can enter. You know, if you don't know so much about the information, I want to show you this information that you can read in every literature. I'm not going to go into details of the construction of what it should look like. It's just this trade idea behind. You can Google it. You can find everything in the internet. I don't want to go into the depths of the analysis. It's just the idea. It functions, not because I'm saying it, because it's very simple if you look at the various scales. Here, the upper peak of the head and the right shoulder. What happens if we look at this neck that is being interrupted? So the lowest point that we have after the top, then we have a drop, and then it goes up again. That's bad. But then it goes down again, and then another one have a little peak, but then we have this neck that disrupts the whole process. Then we say, okay, now I think the bull's being destroyed. So here it went down, and here it's dropping even more. So you can actually follow the chart and its direction. Just to the end, just a little trading aspect that I'd like to show you. Before I mentioned it, it's a very efficient aspect to look at this chart. This means, imagine you have a drop in this triangle. It doesn't matter which direction you went. It's the scenario that's important, because it means that the market is dropping and the market's growing again within the same information area. And it then has a turning point. And if now it was to go back up, we would have a good possibility to enter the market. But here it actually falls within its formation. So that would maybe be the second chance. If you see this, it doesn't matter out of which circumstances. You can see it also from a horizontal line, and then the market drops, breaks, and the market drops and breaks again. This shows that the second breakdown often will drop even lower, which would be the second chance of a second break. Then use it. Don't be shy. Jump in there again when you notice it's dropping at this level. If the first time it didn't actually break through, you can prolong it, no question. Or on the other hand, if the market goes up and then drops back down, it's very easy, because in its logic, I always try and keep it logical. Can you actually see from a market dynamical point of view, can you find a logic behind it? And if you can find a logical explanation to it, then follow it. It's very clear here. The market is being pushed up again, but then what's missing are the people who enter in the market. So you can just drop when you see the turning point. As soon as the downward trend starts, then we know it's going to go down and it's not going to go up. And it's absolutely the same here, but the other way around. So here I drew a few red circles. That's my next topic, these red circles. So who knows about the candle technique? Not many people know it. Can't be. You have to know the candle technique. Come on. Who doesn't know about it? Ooh, you're very shy. So most of you who didn't put their hands up, please look at candle charts. I strongly believe in this technique. Why? Same topic. Because the candles, without wanting to enter into each formation of these candles, they show you which tendency the market dynamics is going to. You have a 5-minute candle, a 1-minute candle, a day candle. It doesn't matter. It always shows in which direction the market is developing at this point in time. That is extremely valuable when you're talking about trading, because they can show their direction. They can show you if there is a wrong turn, if there is a right turn. You know, just to pick it, this is called a hammer. You know, I just wrote down the criteria and the pictures, and you can have a look at it again in detail or check it in every chart book. But if you look at these green parts, they're called a hammer because they look like a hammer. And you see that the market is falling and then shoots back up. So green, it's shooting into the positive area. And then it has an upward impulse. That does not necessarily show the features of the trend. And this is a classical form. The market is shooting up into a resistance area, but then it falls back onto the same day and goes back down to a minus. The next day drops even more back down, and you have the short signal. What does it mean? Short signal means misconception, misleading information. That means somebody goes up, somebody else goes back up. We close there. The next day, then we have the bulls that are just fed up, and the market drops even more. This is a good short efficient, not because I'm saying it. I mean, you can see this statistically. If you look at the hammer and the shooting star, I mean, I have worked with this intensively, and there is a book by Bulkowski. Do you know it? It's 1.5 thousand pages. I'm not joking. Does nobody know this book? You've read it? You read it? Did you really read it? In English or in German? In English. Aha. Good. Anyone who read it in German? You? How did you like the translation? Not good. I didn't like it either. I did it. I translated it. 1,500 pages, and that is not a joke. But with tables. The tables, I didn't have to translate them. What I want to say with it, in this book, that you don't have to read, there were 1,000 chart formations that were written. And I actually tried to focus on the chance risk, the best charts, so that you can actually picture it and see it. There are formations of candles that are not going to help you. But the ones I showed you, the ones I focused on, are the ones I think will help you. I talked about hammer and shooting star in the bullish and the piercing pattern formation, this formation here. So a little red and a long green candle. You can take notes, you can take pictures of it, you can have a look at it again. But the ones who don't know this, if you just base yourself on these and these formations, they're extremely efficient and they're so clear. Just look at them. You can use them for trading. And I always use them, and it's always been quite positive in all my training sessions. The next point that I'd like to make are the indicators. We have finished the visual part. That's what you can see. Indicator, I haven't even spoken about the word indicator, so I'll talk about it now. Who is trading with indicators? Please put up your hands. Most of you. I have to say, me too. However, if you're going to ask me what I prefer to rely on, I have to honestly say is what the market shows me directly. You can never be as directly on the market as with candle information, because the candle information is direct. They give you all the indicators, and all the other indicators are always deviated in time, but they are a help. So I'm going to show you my setup, a very simple setup, and I just want to give you a basic idea. You can have totally different indicators, different ideas. However, I think that what you need less indicators than you actually think you do. How many indicators do you have on the market? Who has more than 3 indicators? More than 4 indicators? More than 5? Come on. How many do you have? 20. Whoa. I don't even know that many indicators. Oh, there are so many. Oh, you sell them. I see. Okay, I get it. And how many do you actually keep yourself? There was a time I wrote down 4 indicators that I use. The volatile indicators, the oligo bands, that we're going to have a look at from John himself. I'm not going to go into detail because John's going to explain it. I have a 200 mean time per year. We'll have a look at it. And I have a mean value. Why? Why is it just a mean value? Why didn't I adapt it? Why? Because what I want to see is the mean value of the market. That's what's important of the 200 days or 220 days, whichever we want to take. We just want to see a median value, how the market is developed. Am I further down? Am I too high up? Just to have an orientation. And then the sub window, I want to place an oscillator. I know there's one that is enough. I know there are some fans that don't just place 4 indicators, but they place more. I can prove to you and show you that if you take one oscillator, it will give the same indicators that you're going to show me. In other words, it doesn't make sense. Okay? I can show it to you really fast. If we had the time, we could try it out. I've tried it hundreds of times, because I wanted to find out whether it's actually of any use to me. And now we're going to have a look inside into the market. Switch the screen and see. You see? Great. I had a look at the DAX. So here it says DAX. And I'm going to amplify the picture. The DAX is ticking and shows that we still have the trade. I mean, of course, now DAX is closed, of course. But just have a look at this flashing. I'll amplify it. What can we see? We see daylight candles within the DAX. How would you trade the DAX? If we were now to look, if we were to act upon daily candles, which chart will we take? Where would we enter? And what can you see at the bottom? You see it's still ticking. In which trend are we going? Here we have the indicators again. 200-day line. I will weigh them. So the last courses are a bit stronger than they were 200 days ago. So we are now a bit better onto the real attitude. So we'll take the 200 days. We're not going to take them as a signal, to buy when it goes up and sell when it goes down. No, it's just an orientation. I look at these specific falls, turning points, falling turning points here. We are quite close to the 200-day line, and we're quite in the middle. And I wanted to show you also from the volatile side, these are the Bollinger bands, the red and the green. So if they go up and fall, which gives us specific information that you might know if the volatility is showing a dynamic move, which is dropping. And then the Bollinger line goes back up, becomes tighter. But John's going to show this later. So what I want to say is that the DAX at the moment is in a bad position. It's going to a bad time. And now if we ask each other, am I going long or short? Should we just roll a dice? Who would say it goes long? Who says short? Short? Who doesn't know where he's going, where he's heading to? None of you know. I'm happy. So I'm not the only one who doesn't know where he's going. So how can we trade on the index without knowing where our signals are? So we look at the MACD. And I will take it. What I also wanted to show you is the trend in the MACD. The ones who don't know the name yet, MACD trend is the mean value. Most of you already know this. We have 12 days, 200 days, mean value, so we get the trend dynamics to have a kind of a straight line. Look at the books. and check Google, the MACD indicator, to find more about it. What I wanted to show you more, here it is. This MACD, this crossover, long signal, short, long, always when it crosses over and you see it's bluish green, and you have the short movements and the counter movements. What you see here are two oscillators. On the one hand, the stochastic, and the other one. But does anyone know the stochastic? Stochastic is just standard. It's not bad. Has anyone heard of Kopok? Nobody knows Kopok? Oh, you have. Good. This indicator is also an oscillator, and it shows that it goes more or less in the same direction, but it has a few advantages, I think, because the stochastic is always limited between 0 and 100 and can never go beyond 100 from a mathematical point of view and never drop lower than 0. So if you look at these signals and you see that the black line goes down and up and the blue line up and down and the upwards impulse in this direction. So if it goes down, it goes in. If it goes up, it goes out. So this Kopok indicator is made of rate of changes to rates. So we have two rates of change, and they are then the mean values taken so that we have an indicator. And you can check this in any book, on the internet, wherever. Just Google it, and you'll find this information. But to show it something different, always be careful when you have the indicated as a supplementary aid. That, as you see here, then look at the divergencies. The divergencies are extremely helpful. Take a look at this situation, this low here, this low in the DAX is a lot lower than that low. We can see it, can't we? So what does the indicator tell us? The indicator tells us the bullish divergence. It tells us we have a strong move towards the bottom, but this move here is not a dynamic move. It's not as strong as the previous one, although the course is lower. This means that the trend, the probability that it's the end of the low is a stronger probability than that the market would drop even lower. There is never a guarantee, but that would be kind of set up, which then tells us, according to this low, if that was the low and it's going to go back up, then we could enter here and then find a chart which then moves. So I try and combine, you see, the indicator. We have the oversold area, and if the course then goes up, I look at the chart and say, okay, the actual trading signal, I'll take it out of the chart. If a resistance has dropped, if we have this candle formation or whatever, and then we can combine it with the oscillating signals, then the trend enters here on the long side. And here, the course falls on the Bollinger sign to the bottom of the market, so that we have this kind of setup that can promise success if we can handle long. Of course, it's over now, obviously. We could have handled it if we had been on the market at that time. So what does the market tell us now? 200-day line is here. We're not very far beyond. We're in the middle of the Bollinger. We have our 200 line balance. There's a lot great dynamic. The MACD as a trend follower, it drops slowly, but there's not really a signal that it's continued to drop. And the oscillator's here in the middle somewhere and doesn't really give a signal either. So that's just an example that we have a chart that says, I have no idea. And if the chart says I have no idea, then I can only say I have no. We enter. And it was said just before by Ron, so to have a trading plan, don't go long or short and say, I don't have a signal, but I really want to enter, then, can just roll a dice. But if we want to go long, what can happen if we go long into a market, or if you wanted to go long, when would you buy? What has to happen? How would it be if we said we want to see that this zone is broken through? So here we have a line. There's not a real resistance. The market hits, the market falls, starts again to grow. But then if you go long here, you'd have to shake every day, tremble, thinking that the market could drop again. That's how I would feel. What we could do is that you enter here at the top, and what would be even more intelligent, that you wait until the market breaks through to the top, goes back, has a withdrawal, and at that breaking point, position yourself. Can you remember the second chance? You're going to have this so often. The market goes up, you're in, and you think you're just being played with, and you get really annoyed. Then just wait. And then break through, next breakthrough. And when the next breakthrough, if it doesn't come, then you missed your chance. What if the second drop doesn't come? What happens then? Then you're not in. Then you're also angry. I mean, that's the bad thing about trading. You always get angry at some point in time. However, I can tell you, you're just going to get angry if you're not there with the trade, but you're even more angry if you're in the wrong trade and you get caught and you have to leave with a loss, because the trade where you're not there, it doesn't cost any money. But if you enter too fast and too early and then you buy with a loss, and then you get even more angrier, where should you drop out? Where should you go out? Here, I'm going to do it fast now because we want to look at more markets. So where should we drop out? I just look here. Okay, last stock. So the last place. I'd like to show you something else. I never define lines, always zones. So always helpful lines. This would be here, for example. So take that back up. See what I mean? This is just a piece of advice. So when do you get the information? So let's say the market breaks through here and you go back here, then bad luck. So you should always take it when here. You see, I'm moving it here, and I'm moving it very consciously into this area, and I can show you why. And it does make sense, because everyone can draw lines, but think what these lines represent. These zones, these are the 200 lines, 200-day lines. Here, there was a strong movement in the market, and then it shoots up, resistance, drops back, and comes back in here. So these two lines give me a zone which showed me the last days and the last weeks, which were massive. And if they've been broken through, you can really bet upon the fact that it's going to drop. You don't want to be long here, because somebody would, if you'd have a drop if you went in long here. It's very easy. It's very simple. But, it's nothing that drops from the sky. You can see it with your bare eye, and you can interpret it and say, what are these people? What are these candles here? These candles here, and the hammers here. This one, a hammer. Just very shortly, per definition, it happens when you have a downwards movement. So here we have a bullish scenario being supported here, and we have a bullish hammer due to the resistance. So what do we do here? We have the traders here that come into the game. Where are the traders? Nobody here? Here? They're happy now because they go into the 5-minute charts, and then they trade this day to the top, up to the resistance, and they trade nicely the wave movements towards the side. That's a swing trader. That's how we would call them. That's what it would look like. I'm showing this to you in the 5-minute charts for the following reason. Can you see it? This area it's movement towards the top, the breakthrough to the top, the lines that we had before. We can move it to the 5-minute charts, and you see the movement is going into a day chart. Here we have again our support, the resistance zone, and you can see again the critical situation. Where does it go? To the top? I don't know. To the bottom? We'll wait. Will the market go to the top? Will it fall to the bottom? And if you do it in a very clever way, then that's what I always do. Put your limit or your stock set up here. That means if you say, I want to work on a breakthrough, like this, for example, then you will be triggered onto the longer side if the market, I just put this there, to beyond these values, and they automatically have their course here. 20 euros would be what, then you'd drop out, and with 10 euros you would automatically have a stop and break out. This is the graphic trading. I find it quite comfortable, and you can always decide upon your stop and your limit and adapt your stop and your limit. Just by clicking with the mouse, you have your total setup. So I can't get back to what I said to you at the beginning. Exactly this setup is what you need. You should have an aim, a course aim. I mean, I just put 20, but it doesn't mean you have to be 20. You look at the left, what's the next resistance, the daily chart. We didn't have any here. 5-minute charts, and you have to look back a year. And then just take your 20 euro target or leave it open to the top and see how far it goes. But something has to be at the top. I mean, the 5-minute charts, you need 15 DAX points, which means euros. And we have a Euro DAX, which has an acceptable course. You don't need 30, 40 DAX points on the downside. You don't have that in the 5-minute charts. It's really, really seldom that you get that. So have a look again at other markets. What would we like to see on the Swiss market? Should we look at the Swiss market? I'm joking. So Swiss market. It's similar. Okay, rapidly. I'm just going to go through it really fast. And we want to go through a couple of markets more so you get a few more ideas. We still have a bit of time. So what does the Swiss market tell us? It was better than the DAX. Did you see? It's more stable. Did you notice that? We're again at the top, and the DAX is not there yet. However, to be critical, though, what it would scare me here is the fact that here, I'm just going to go through the line, not the zone. See, here we have a breakthrough, and what's it doing right now? It's here. What is it? What is it? It's setting back down. That's what have I been saying? It goes up and falls. So when do you act? In the second chance. When do we get the second chance on our market? Could be now. Could be creating itself right now. Could just be creating itself because the fallback has a different drawback. Do you know what I do? I'm going to take this out. Just maybe we can get the picture bigger here. This was a massive resistance, the top. And beyond that, setbacks, drawbacks. And then we're right back into this area. Now it's stabilizing. The market's stabilizing itself again. So we're looking at the scenario to get a second chance. It's just building itself up. So now you still have the danger, obviously, that we can also have a fall, drastic fall. But so I said something, this situation, so the prior up, fall down, second chance, the drop is being taken up again, then we get a dynamic in general in the market, which then in general can then reach through to the breakout that we saw before because more buyers will come onto the market. You see, that's what I just explained from a theoretical point of view. Look at your own market live. I mean, it's not the case yet. There's still some points missing, but you can have a look at your market, and the intraday traders amongst you can do exactly the same. process. They just go into the short-term chart, the 15 minutes if they want to, and then they act or they trade in direction of resistance, which was where? Can you remember? 950,000 points, more or less. Here. That means that if you trade short-term, then you can still get the impulse and follow the impulse. If you go into the day chart, it's not as easy. But this is the situation for short-term traders who look at the impulse and catch the impulse and can still follow it. And what you can also do is, where's the stop? If we are in the Swiss market and we want to follow the impulse, then we can see, I'll just make it bigger again, the critical scenario. And if we fall below this limit, I would step out. We can see the course, more or less than 900, 500. And we're trading short-term, but we also have to be ready short-term to just get out. And that would make sense here in this area, not here at the bottom. Let's have a look rapidly at a similar scenario. Shall we look at Euro US dollars?
We still have time. We're a tiny bit later, but we'll make it up. Everybody will speed up a bit. Don would have 10 minutes more. What would you like to see? You can choose. S&P 500. That's interesting. Unbelievable. Yes, I can tell you that they're new highs. I've taken a look a couple of hours ago, but now it really exploded. It's really high, so what happened? The setup we had for the SMI is anticipated here. Here we already have the breakout. The Swiss index is a little bit behind. So what happened here? Can you see? Here we are. Here. That's it. Is the opportunity. Because here I have the idea we just talked about. Here I should come back to what we've seen for the first breakout for the SMI. We still have the 5 minutes chart. And new highs, it's live, it's still ticking. Now if you're a 5 minutes trader, I don't know. Who would take long? Who would go long? You have a 5 minutes chart. Would you go long? Anybody brave in here? Me neither. Because I think that right after such an increase that happened 5 minutes ago, there might be another 5 minutes candle, and then there might be a correction. And then we have a second chance, also in the 5 minutes chart. So as an trader, you can ask yourself if you would like to follow the market, run behind the market. You observe it, you wait for the correction, and if there's no correction, well, then you can be annoyed. If there isn't a correction, then you can be happy. You could bet. So that's interesting, it's dynamical, so there is an upwards move. But personally, if I worked in a 5 minutes period of time, I wouldn't do it. It's 7 o'clock, that's early in America. They're still trading for a couple of hours. Things will keep on moving, so I wouldn't follow. And that holds true for all the markets. Think of the second opportunity, breakout, correction. And if the level comes back, then you can enter, because the bulls still have the setback. So we're running out of time now. Then I hope that I was able to give you a couple of ideas, also about the overall approach, about the indicators and the techniques that you can combine, as for instance the second chance break through the confirmation via the indicators, and I hope it was helpful for you, and I hope that you continue trading with a lot of success with IG Bank. Thank you very much, and enjoy John's presentation. Thank you very much.